Is this the Fed's pivot? Welcome to the Real Vision Daily Briefing. It's Wednesday, November 30, 2022. I'm Ash Bennington. I'm joined today by Dave Lauer, CEO of Urvin Finance. Before we get started, a quick reminder, our live chat function on the Real Vision site is temporarily disabled. So please drop your questions in the comments section on the RV website, in the live chat on YouTube, or tweet us at our Twitter handle at Real Vision. Dave, monumentous day. We should just jump in and give a little bit of a summary, I guess. Obviously, it's a big day in markets. Chair Powell signaling rate hikes that the rate of slowdown of hikes can begin as soon as December. That's December 13 to 14. That's when the next Fed meeting is. U.S. equity markets are zooming. Let's take a quick look here. Looks like the Nasdaq bouncing around still a little bit here at the close, but 11,465 still moving on my screen. It's up nearly 4.5% on the day. S&P 500 over 4,078 right now, up about 3% on the day. Dow Jones Industrial Average up about 2%. So Dave, how do you contextualize this? How do you think about this? Obviously, Fed signaling that the rate of increase may be slowing down. Give us some context. Tell us how you think about this big picture.
Sure, Ash, and thanks for having me on. I think that markets are having a really clear reaction to the press conference and the discussion, and so clearly they think that the Fed is going to moderate its rate increases, and they're rallying based on that. You see the dollar selling off. At least I checked against euro and CAD. So it's clear they think things are about to slow down. The market seems very optimistic right now in all sorts of ways, right? It's almost flat on the year, and it's been a hell of a year, so, from the S&P's perspective at least. So the question really is going to be, how does the Fed interpret inflation numbers going forward, going into sort of the spring? Do they react to the data? Does the data start to show significant deflation or disinflation, which I think it will. And so if that pushes them to start, halting rate increases come early next year, I think that would be really good for markets. If they maybe even, I think if you look at what market expectations are, the market expects rate cuts to start in about a year, next November. I think all of this would be pretty bullish for markets and, could mean that the Fed kind of nails this soft landing versus, the hard landing if they continue to kind of push hard on rate hikes.
Yeah, we should also say DXY dollar index below 106 here, 105.89 on my screen. Off, it looks like about 1%, down about 1% on the day. So Dave, go ahead.
Yeah, I mean, that's just, a good indication of what the market is thinking in terms of relative interest rates to other countries. And, the fact that Powell is, maybe pulling off the table a 75 basis hike and the market's now pricing in a 50 basis point hike for the meeting in 2 weeks, and maybe even more slowdown coming into, the early next year. I think that's all good for markets.
So Dave, let me make the pessimistic case. I want to read from Chair Powell's speech today. I watched this speech and reading the readout here. I think there's some reason to be concerned. Take a listen to this. So monetary policy affects the economy and inflation with uncertain lags. We know that. And the full effects of our rapid tightening so far are yet to be felt. So more gloom coming in terms of the impact of growth and also the other side of the dual mandate in terms of the labor markets. Thus, it makes sense to moderate the pace of our rate increase as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increase may come as soon as the December meeting. So reiterating what I said here at the top of the show. But look, take a listen to this. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments. So he's essentially saying here, and he goes on to say, it will take substantially more evidence to give comfort that inflation is actually declining by any standard. And this is really the thing to zoom in on here. by any standard, inflation remains much too high. So, okay, we've got rates that rate hike path that needs to be moderated because of some of the grim news that we're seeing in terms of growth. And yet simultaneously, inflation's still too high and the terminal rate may need to rise. I mean, that sounds to me like trouble on both sides of the dual mandate. Obviously, we see this rise in U.S. equity markets today on the news that the rate hike path may be slowing. Yet nonetheless, Dave, sounds like some trouble in the economy more broadly.
Yeah, I think it's funny if you look at the reactions to Powell today, you see as almost as many people coming away saying, "Wow, what a dovish statement and answers to questions," versus as many people saying, "Boy, that was more hawkish than we thought," and the truth is probably that he really didn't say much. But from what you read, something that has been concerning me and something that I'm glad he acknowledged is this idea that what they've done has a lagged impact and that we haven't actually seen the impact of it. And that's sort of the problem with economics broadly and trying to control it in this way is you're doing something at a point in time and then you're trying to figure out how is that going to ripple through and across the economy.
Right.
Inflation core PCE right now is high, I think around 6%, which is way too high for what Powell wants to see. And I think there's a lot of sort of PTSD from the 70s and the reaction that was required in the 80s and by Volcker in order to get inflation under control. And they're trying to avoid a repeat of that. Now the question really is going to be, do we see PCE drop significantly? Do we see inflation drop significantly? That's the big question. And and will they be reactive enough to the data? So, on one side of the mandate, employment is looking extremely strong. And part of that is problematic for the other side of the mandate, obviously, which is to control inflation. And then he sees markets rally like this, and, it leaves him even more concerned that the wealth effect of the market rally can also generate some inflation. So, I think one thing that we are seeing is that we're seeing spot rents declining significantly. We're seeing a lot of the supply chain issues moderate that were contributing to inflation in the first part. I really think from what I've seen and from the people that I respect who I follow, I really think we're seeing that inflation curve turn over. And it's going to take some time. I do think the markets will breathe a huge sigh of relief if they get a 50 basis point hike rather than 75. And if the Fed really focuses on that data-driven approach, and we start to see inflation numbers continue to moderate, if we don't see that, obviously it's going to be a different ballgame. But it does feel like coming into the spring, we're going to see real significant deflationary or disinflationary effects, especially coming out of rent and housing values because of the lagged effects of these interest rate hikes.
So talk a little bit about those lags. Obviously, those lags are a challenge for the central banks around the world. Chair Powell pointing to them in today's speech. Talk a little bit about how those lags work and why they can be problematic for policymakers.
Yeah, it just takes time, right? It takes time for something like controlling the Fed funds rate to filter through into mortgage rates, to filter through into a housing market that has been so frothy for so long. It's just human behavior. It's right. Sort of, when you start to study behavioral economics, you start to see all these cognitive biases that are having these effects where okay, I wanted to go sell my house. Now that interest rates are higher, it means that if I want to get the price that other houses went for that were similar, other comps in my market, it's going to be 50% more to service that mortgage. And so people aren't willing to pay that, but I'm not willing to drop my price just yet. It's going to take time. It's going to take pain. It's going to take urgency. And so, you've started to see housing prices turn, but you haven't seen them crash yet. And hopefully we won't see them crash, but they do need to drop significantly in order to realign the cost to service a mortgage with where it was before. And so, that kind of thing, it just takes time. And then it takes time for businesses to adjust to, they don't have such easy access to debt anymore, so they can't grow as fast. You're starting to see a lot of layoffs as people, firms hunker down, all of this. And when people get laid off, they get some level of unemployment, so their spending doesn't drop right away. Again, all of these are lagged effects that just simply take time to filter through. And then, the other side of it is inflation. There were all sorts of causes of inflation, but certainly some of the biggest ones were supply chain disruptions and COVID. And of course, that all of that is moderating as well. But these things take time. Shipping containers don't just automatically fall off the boat into the port. You've got to start to work through your backlog there. And so I think that everything that we're looking at is it takes months and months to normalize the system. And we're in that process now, and it might not, it's easy to not feel that way when you look at the numbers and they're almost as bad as they've ever been. Certainly for the last couple of months, inflation numbers have been so bad, but improving just slightly. And so you start to see those slight improvements, and maybe you hang your hat on, okay, this is a trend. I can kind of piece it together. And now we're going to see, I think a few people think that core PCE will hit a 2 handle by next year, even if there isn't a recession. And were we to be in that situation where we dodged a recession and we've gotten inflation back to around 2%, man, that would be just something for the record books. If the optimist in me is right.
Well, it sure would. I don't believe that core PCE or inflation of any metric has ever fallen that rapidly before. But as you say, we're in unprecedented times. Dave, one thing that doesn't operate at lags, that does happen right away, is traders over at the CME. This is Chicago Mercantile Exchange, trading 3-month Euro-dollar futures. These are options on interest rates, essentially. If you're trying to get a proxy for this, I'm looking right now at my Bloomberg terminal here at the WERP function. It looks like an implied rate delta for 12/14. That's the next meeting, December 14, of about 52 basis points. That's coming in, meaning that traders are pricing in actively this information and trying to moderate their call for when the next Fed hike might be. By the way, if you don't have a Bloomberg terminal and you'd like to get some rough proxy of this, you can go up to the Atlanta Fed's website. They have a market probability tracker that will give you some indication of the direction that traders on these Euro-dollar futures think that rates are going. Dave, does that sound about right to you, a 52-point delta from where we are today, basically pricing in pretty close to two 25 basis point hikes?
Yeah. I think that given what he said today, and given the fact that we're starting to see inflation roll over, and we're starting to see some really sort of leading indicators, like I said, especially around rents. I think owner equivalent rent was just a huge contributor to inflation, and now we're starting to see that could be a real contributor to disinflation. So I think the market is going to change its expectations, and what you've seen in that shift is the expectations dropping to 50 basis points and the market rallying 3 and 4.5%, depending on what index you're looking at. So
right.
I think that and honestly, just from being a prudent approach to economics, do the 50 basis point hike. You get your hike in at the end of the year. You've gotten the Fed rate up to close to where a lot of people think it should be, which is somewhere won't quite be to 5%, but that's probably sort of close to the terminal value, 5%, which is where you want to get to. And then expect that even towards the end of next year, you'll start to see some rate cuts as if things really do slow down, as these lagged effects start to filter through sort of into middle of next year. You don't want to see the economy slow down into a recession, so you might end up having more stimulus at that point.
Hey, Dave, since you point out, depending upon what index you're looking at, let's break down SPX by GICS. This is the sector breakdown of what's happening in the SPX, and there's a lot of delta here. Information technology, clearly the leader on the day, up 5.03%. Communication services up nearly 5%, 4.92%. And as you just kind of come down to the laggard of the day, which is energy, up about 50 basis points.
Yeah, it's and you see it even just at a high level, the NASDAQ relative to the S&P, like there's a clear growth and tech rally here. and defensive sectors are not participating as much. So that it's interesting to see. It very much feels like a risk-on rally, and the question is going to be: is this something that's just kind of a knee-jerk reaction, which you can often see, and then the next day you're going to see a complete retracement, and does the market resume sort of its defensiveness, and still have concerns about a hard versus soft landing? Today looks like the market is saying he might pull off the soft landing, and I don't know what the market's going to say tomorrow.
Dave, this rally has really brought out the optimist in you.
It has, yeah. Actually, it's funny because I was pretty pessimistic for most of this year, and it feels like the worst has not happened. I mean, inflation has been a horrible force, but from a market's perspective, I was definitely, and I hate to admit it, but I will own up to it. I was very much a team transitory on the inflation side of things, and that clearly has not been correct in terms of the magnitude of the decline in inflation. But overall, I still think I lean towards that side of it, which is inflation is really going to be coming off pretty quickly now. And so, the danger to me now is that the Fed overreacts on the hikes versus underreacts.
By the way, for people who are following this on the ETF side, XLK, this is the select sector spider for technology out of State Street Global Advisors, up on the day 4%. I want to flip the script here a little bit and talk about some pessimistic sentiment. This comes to us from a conversation between Andreas Steno-Larsen and Andy Constant. The title of this show on Real Vision, which I believe is out earlier last week, is it just another false dawn? Let's take a look at that clip.
I think the most important thing to recognize is that the transmission mechanism for rate hikes in the U.S. is very different than it was decades ago, and very different than it is in versus other countries. Rate hikes affect consumption because they may make cash look attractive relative to using it and spending it for goods. But they also make leverage more expensive. But the U.S. Homeowner, the marginal homeowner that has to relocate is faced with high mortgage rates. But the holders of mortgages on existing homes, they're flush. They have interest rates that are, less than 3% in some cases. And those aren't going up for 30 years. So that transmission mechanism in the U.S. is just difficult. And so you have to use the wealth effect. That's your only other lever. And that means that negative reinforcement whenever asset prices go up. And we've seen both equities and bonds, but in particular bonds, gold, other assets, all spike since the Fed. And that's not what they want. Regardless of your opinion of the divisiveness within the Fed, none of them want an asset rally. So I expect they'll correct that at some point in time, unless the numbers just magically fall. And I don't think they can magically fall without jobs magically falling.
I just want to double click on something Andy Constant said there, Dave, because it really is very much congruent with the points that we were making. Quote, the transmission mechanism in the U.S. is just difficult. And so you have to use the wealth effects. That's your only other lever. Regardless of your opinion of the divisiveness within the Fed, none of them wants an asset rally. And here we are looking at this jump on NASDAQ of over just about 4.5% on the day as the numbers have settled down.
Yeah, and kind of what I had mentioned before. I agree. I don't think the Fed wants to see markets rally. I don't know that they pay a ton of attention to sort of these short-term gyrations. And I do think there's the other side of the wealth effect, which is even though people might not be forced to buy or sell their home, or might be refinancing, they're still going to see home price declines, right? There's no way around that. And they're going to feel they're going to know that their home is not worth what they thought it was last year or the year before. So I think the wealth effect through that sort of transmission mechanism, I wouldn't just dismiss it out of hand. And I think when you think about inflation, right, the standard inflation equation is just inflation is whatever inflation expectations are for the next period. And so, when you see prices start to decline, and then you see, when it starts with housing prices, when the market for housing really starts to come off, I think the emotional impact of that is going to be really significant, because the emotional impact of rising housing prices was so significant in the U.S. and in other places. So, to me, I don't know that a couple of days or a week of a market rally is going to influence Fed policy in the same way that these consistent numbers and economic readings that are coming in will. So I'm not as concerned. But again, I don't even know what's going to happen tomorrow. How many times have we seen the market rally like crazy on some bits and pieces from a Fed statement, only to retrace the entirety of it the next day. So I think we'll just have to see in 2 weeks what the Fed really comes out with. I think this will probably be one of the most watched statements from the Fed in a long time. Knowing that the pivot might be here, and if it is, trying to discern, what is it that they're looking for, and what is it that they're afraid of. I think a lot of traders are going to be trying to forecast those things out. There's a huge opportunity here as markets are becoming more volatile and trying to digest this information.
Talking of which, I'm looking at our viewer questions here. Obviously, there are a lot of interesting views and some opinions baked into these questions. I'm just going to start throwing them out to you, Dave, to get your view. This comes to us from Fred Croft on YouTube. Since this isn't a pivot, and it's not, do we think that the market's pricing longer-term bonds appropriately?
Look, the market it prices, right? Like, if you're questioning whether the market's doing it appropriately, the market has something to tell you. I just think that a lot of people, a lot of really top economists, a lot of brilliant economists have been pushing for a while now that the Fed should not overreact, and that the danger. For a while, the danger was underreaction, and that's what they did, and that was why we found ourselves
for years
in this situation, right? I'm not trying to get political here, but inflation right now is 90% Fed and maybe 10% fiscal policy, right? To me, this is all the impact of monetary policy, so they underreacted for too long. And that was the risk coming into this year, and that's where inflation crept in. And so now I think a lot of economists are concerned on the other side, that they're not paying enough attention to the lagged effects, and that they're in danger of overreacting into what is proving to be a strong and resilient economy. Say what you will about global economies, but the U.S. economy has just weathered this in an incredibly resilient way, to me almost a shockingly resilient way. When you look at continued GDP growth, the GDP number was really what was it, like 2.9% today. That was a very in line with expectations, but a pretty impressive number considering we were at negative GDP prints before that. The job market,
two consecutive quarters, in fact, of negative GDP growth or contraction.
Right, and so now we're seeing an GDP growth, an increase in the face of Fed hikes, which is unusual, but it also goes to show you that those negative prints were not. Look, I have not been in the camp that those negative prints meant a recession. I think there are lots of other indicators that show that we have not been in a recession. And if we were, this was the first recession in which unemployment was at this level. It's I think an astonishingly resilient economy. So I think because of the resilience of the economy and the American consumer, what we have seen is that we have been better able to weather these hikes. And so now the question is going to become, can they moderate in the right way? Does inflation really turn over? And if so, then again, like we could be in that Goldilocks zone, but it's hard to say.
Yeah, and yet we have job openings declining on the JOLTS report. So lots of different variables moving in different directions. Here's a question from Abir, who seems to have decided that this is a pivot. I don't know, maybe I'm reading that wrong. Quote, so the market decided that Powell was dovish. Can he do a U-turn at the next FOMC? And does he realize he's almost erased all that he has done in terms of stock markets?
I think that's a very reasonable point. And, I don't think that Powell wants to see markets where they're at, but I really don't think that that's what he's focused on. I think, the Fed is focused on inflation. It's focused on employment. That's the dual mandate. It's focused on economic growth. And I also think when you look at the general levels of inequality, the wealth effect from markets is, accrues so much more to the wealthiest in society that, it doesn't quite have that same widespread distributive effect like it might have in the past. And so, right now it's housing prices and rent levels and food prices are far more impactful to everyday people. So, I don't feel like Powell's painted himself into a corner too much, but I do think that he, were the Fed to hike another 75 basis points, I think that would be a huge problem for markets. I think you'd see a real violent reaction if he doesn't follow through with the 50 basis points. I think what he's done though is given himself maybe runway to continue with those 50 basis point hikes up to 5%, and then to see where to go from there, with the potential to incorporate some information, as it comes out, maybe inflation really does come off and he doesn't need to go all the way to 5%.
Yeah, that's an interesting interpretation. That does sort of split the difference of him making those comments sort of on both sides of the dual mandate. Maybe that's the path forward, a slower rate of increase, but continuing for some time to come. Dave, I know we've covered a lot of ground here today. We're just about out of time. Give us your quick key takeaways, final thoughts that you'd like to leave our audience with. Obviously, an eventful day.
Yeah, it's been a fascinating day to watch. As kind of why you come into markets for a day like this. New information comes out. Everyone's trying to digest it, understand what's going on. I think that I'm turning more optimistic. I think there is a soft landing in sight. I don't know if they'll pull it off. If they do, as we were saying, it would be one of the more historically impressive monetary performances that anyone has seen. And coming out of sort of the ZIRP years, it's even more impressive. I see plenty of bears out there who, including, Michael Burry, who had tweeted something earlier today about there's no path out of this and we are in for a multi-year recession. I mean, I guess that's one way of looking at it. But, like I said, I think the U.S. economy has been so resilient that it seems less likely to me. And, I think hopefully we'll see the glass half full and we'll see the Fed moderate and we'll see inflation come off. So it's a fun time to be in markets, that's for sure.
Yeah, it's interesting that you should mention the bear case. I'm looking at the YouTube comments scrolling by, and I just saw someone type soft landing JFC. So there are definitely people out there who are very skeptical about the soft landing scenario. But important, I think, to point out the Burry call and some others who have been more bearish in this market. Okay, Abe, I'll give you my takeaways. Pretty easy conversation to do today. What are the key takeaways? Well, the takeaways are that Jay Powell has just signaled that the rate of increase is going to slow as soon as December, but he's also told you effectively that we have trouble on both sides of the dual mandate. Inflation right now is still far too high. There are signs that it is going to continue to stay too high, according to Chair Powell's interpretation of the analysis. And yet, simultaneously, clearly he sees the risk of recession rising. He sees the risk of challenges on the employment front being problematic, and hence we get exactly where we are today, which is this sort of this weird sort of almost schizophrenic view of what's happening in the world. Dave, thanks so much. This was a great conversation. Hope you'll join us again.
Sure thing. Thanks for having me, Ash. Appreciate it.
And thanks again to everyone for watching. Real Vision Daily Briefing. Weston Nakamura is back tomorrow with Daniel Lacal. See you then. Have a great afternoon, everybody.